I want to talk about the U.S. just received a downgrade to the credit rating. Should you be worried? Because it was kind of frightening when it came out, like, oh my gosh. But, last week, Moody's, who announced the downgrade to United States sovereign debt rating. And this is hard to say. It's big A, little a, because it's not a triple A. What Moody's does is they have a difference between a capital and a regular A.
Yeah, the way I said it when I was on Fox 5, I still called it AAA just because it's simple.
Yeah.
It is the highest rating, though. Well, it's not like 3 big A's is not better than 1 big A and 2 small A's. It is the highest rating.
I just like S&P. Much better just you got the
AAA.
A's. Yeah, AAA. But this is I'll say AAA. They reduce it down to a AA1. So it's just below that. While it's a downgrade, it is important to understand and can have negative consequences for the interest rates on the debt. This downgrade, it's almost so late to the party. It seems like when it came out, oh, yeah, I guess that's bad. But and they do have rules as far as what they're going to downgrade it for. But it just seemed like everybody else was down. You're the last one to the party. Why the delay?
Yeah, and I mean, we'll kind of talk about the other downgrades that had already occurred. And again, there's 3 major rating entries. You already talked about Moody's, you talked about S&P, and also the last one is Fitch. Well, Standard & Poor's, or again, S&P, was the first major credit rating agency to actually downgrade the U.S. debt. But again, as you said, were they late to the party? And the reason you say that is the Standard & Poor's did this in August 2011. I mean, we're about 14 years later now here. It's kind of like, what?
There's people weren't in the finance market back 14 years ago.
No. And I mean, the thing you look at is the reaction to that move from Standard & Poor's. That scared people.
Yeah.
The market, the stock market, that fell about 6.7% the day after the announcement of the downgrade.
And I think what the concern has been is that there is concern going forward that the debt's going to rise. And I feel when I look at this and I read this, I just don't think they're giving any credit to what I see as a growing economy going forward. I mean, you hear about all these big deals we're having with people investing in our country, and you hear about all these positives, the labor force. And I think they're looking at that the growth is going to stay the same, but with higher debt. And they're not. I don't think they're taking into account the tariffs, but we're going to see how this develops. And I think it's an overreaction to it as usual, but I think it'll be fine. And Fitch, well, they lowered their rating on U.S. debt back in August of 2023. The stock market, when that happened, it only lost 1.4%.
Yeah, and then the last piece of the puzzle here, so to speak, again, we talked about how Moody's downgraded it. Didn't even move the needle. The stock market actually went up on Monday, which is the day after stock trading essentially took place, the day after the downgrade occurred. Because I think it occurred Friday after stock trading last week. So, I mean, again, not a very big impact. And the way I look at this is it is concerning. And I talked about this when I was on Fox 5 the past week. And the reason it is, I mean, and this is a worst case scenario, right? But the reason you want to have strong debt ratings is you want your debt to be attractive. And the reason that's so important is if your debt is unattractive, people aren't buying it. The debt market is supply and demand based. So if nobody's buying your debt, what has to happen if your interest rates have to go up to then meet new demand and bring people in to buy your debt? But if your interest rates are rising, what does that mean? Your mortgage rates are skyrocketing, your auto loans are skyrocketing, your credit card rates are skyrocketing. That is the problem if the debt continues to have issues. But as I said, I do agree with you. I think this is a huge overreaction.
And we got to remember that the U.S. debt, well, it's still considered very safe an investment, very safe asset. With that said, the U.S. does have to do something. We can't go on the same path we're on. As I said, I do believe the revenue side, the growth of the economy will continue to increase, which kind of help offset this. But we got to do something to reduce the deficit problem, because if we don't, there could be further downgrades from the credit agencies down the road, which would be a problem. I don't see that happening. I think, again, a lot of things I'm reading and seeing, I think right now, this summer, we're going through the most difficult part. And after that, fall, I think we're going to start seeing some clear horizons that go through fall in 2026. And I think things look pretty good going forward.
Yeah, I mean, obviously you have your concerns, and the big one is you have two parties, right? Democrats, Republicans, and they're trying to come together here on this tax bill. And the issue that you have is you have to make deals.
Yeah.
But to make deals, nobody's talking about making deals to cut benefits and raise taxes. It's, okay, well, give me a little bit more of the benefits, and then, okay, we'll give you a little bit more of a tax cut. Well, while you're right, you're going to have maybe growth to GDP. I am hopeful that maybe they are a little bit tighter than what people are expecting, because they don't want to be over restrictive where you all of a sudden lose GDP growth, but you also don't want to come out willy-nilly and be like, yeah, we're just going to goose the economy along. We're going to cut taxes. All the benefits will stay the same. That would be a problem in my view. And I think you've seen the 10-year kind of react a little bit negatively to talks around this tax bill, because people are a little bit worried about the deficit. And my hope is that, yeah, maybe we get a little bit more that is not loosey-goosey, I'll call it, and then that 10-year can kind of rein back in somewhat.
Is that a technical term, loosey-goosey?
Loosey-goosey, yeah. It's, learned it in finance school, actually.
Did you really?
No.
Hey, you never know. I mean, they could have. And actually, I do have I've been reading, and I'll summarize this in a post for people probably in the next week or two. But I've been reading, when you compare our country, our economy, our growth compared to Europe, I was shocked at some of these numbers. We're not talking just a few years. We're talking many, many years that we've done extremely well. I'll tease with that and say, just stay tuned. Make sure you sign up for the newsletter. We'll probably talk about it here on air. But we're going to be fine. I'll put it that way. So
I'm not worried. And again, being still AA, it's very safe debt. It's not like, oh my gosh, we're junk status. I mean, we are so far from that, and we would have to have serious issues. Yeah. And I just don't see that happening. I don't want to say I don't care about the debt rating downgrade, but very little impact into how I view the economy, how I view the stock situation.